Welcome, everybody. Thanks for being with us. It is time for our quarterly financial planning webinar. We do a series of webinars throughout the year where each quarter we'll do one financial planning topic webinar and one that is more about the economic and market update. We will be doing that in April as well. This time we're kind of blending a little bit of the two because there's a lot on people's minds to talk about. As far as I'll be your host today, sort of the MC, as we have a number of our team members presenting. I do want to remind everybody that we are recording the webinar, and your continued participation implies your consent to share if you would ask any questions and participate that way. It's also for compliance purpose. I want to mention that we do have disclaimers at the end of our presentation, but keep in mind that opinions are subject to change. And although information has been derived from sources that are believed to be reliable. So it is March 16th, and there's a lot to talk about. To join us in this process, I'm joined by Brian Regan, who is our firm's Chief Investment Officer, and he will be joining us to talk a little bit about what's been going on in the world and in the markets. Scott Birmingham, our lead financial planner, will also be joining us. He's also our Chief Compliance Officer. Talk a little bit about some perspective that your financial planning can help provide you in uncertain times. We'll also be joined by Mike Perna. He is our sort of senior statesman with 30 years of experience behind him, and he'll be sharing some of the tax considerations as we're in that time of year where we want to remember about tax time, and he'll have some minutes for you as well. Finally, Jeff Perry, who is JD, who is not only brings his wealth of experience from a political and legal perspective, but also his passion for personal finance has caused him to generate this program called Something More Mentoring that he'll share a little bit about later in the program. Our agenda is just that. I think I've kind of given you an overview of things we will be talking about. I will remind you that should you have any questions throughout the programs, we will be trying to pause at the end of each segment to allow you to bring in any questions that might fit into the area of discussion. So if you have questions, don't hesitate to use the Q&A button. It's generally either at the top or bottom of your screen. And it's a good way for you to comment or request an answer to an greater clarification, or if you want to push back on something that we've asserted. Certainly feel free to do that. There's also a chat button. You can use that as well. But I think the Q&A would be our preferred manner. And then I wanted to also remind you that this webinar will be posted on our website and through our YouTube channel later in the day. So if either you don't get to see the whole thing, or if you'd like other friends or family to have an opportunity to be exposed to our commentary, feel free to share this. That will be posted on the website, amrfinancial.com. And because these are fast changing times, I encourage you to listen to radio podcast. We do put it out weekly on radio, but also it's on Something More with Chris Boyd podcast. You can get pretty much anywhere you might listen to podcasts, or on our website to find that. So, and that'll keep you up to date on our current thinking of what's going on. Now, in 2022, many things are changing. We started the year with more significant concern for COVID as the Omicron was escalating with infections and anxiety affecting the markets. Now COVID worries have subsided sharply. With widespread immunities, whether from exposure or vaccinations, the economic threat of COVID seems substantially dissipated. And more variants may come, but it seems unlikely that the degree of economic disruption will be the same as it's been in the past. Here we are 2 years almost to the day since we started this COVID experience with shutdowns and so forth. In the meantime, we've also had the Federal Reserve talk about tightening in the face of inflation. Inflation has become materially more complicated in recent weeks. Brian will speak to this issue in his remarks at length. The Federal Reserve is widely expected to begin its tightening process today, but faces economic pressures of rising commodity costs, which also have a slowing effect, while at the same time raising interest rates, which also may tighten. So the risk of overshooting the mark may be even higher that we could be concerned about over time. Threading that needle is going to be very difficult to avoid affecting the inflation rate, but not sending us into recession. In the meantime, we've seen war in Europe, Eastern Europe, with Russia and Ukraine. And again, this has a material impact on our inflationary pressures that Brian is ready to talk about. So I will turn things over to you, Brian, to take over. Feel free to take over the screen.
Okay, will do. So thanks for having me, guys. I know this is the financial planning webinar, and I consider myself a guest lecturer on this one. So thanks for having me. I want to start with some of the obvious and walk through what happened really before the invasion and after the invasion, how the dynamics changed quite substantially. So let's start with the fact that the market's in a correction. You can see that the NASDAQ there is down almost 21%. This doesn't include yesterday's and today's performance, but prior to that, the S&P was down almost 13%. And the Treasury security, the 7 to 10 year Treasury security was down about 4%. So, what led to that? At the beginning of the year, we thought we would have choppy markets, encourage assessing risk profiles. We talked about that in our webinar. But admittedly, it's been more volatile than expected, and primarily due to the war in Ukraine. We've had extraordinary stimulus coming out of Washington from both the Federal Reserve and from fiscal policy from Congress in both in 2020 and 2021. And that eventually led to the S&P being overvalued at 4,800. We were setting our range between 4,200 and 4,400, and then raised it from 4,300 to 4,500. And it's really been that since the middle of 2021, if you look at our letters closely. We had stressed supply chain by the overwhelming desire for goods and labor constraints caused by the disease. And the ensuing inflation led to a continuation of the tightening cycle. And I know Chris mentioned that the Federal Reserve is expected to start the tightening cycle. And he's right, and of course, when he means that they're going to start raising the short-term interest rate. But they've been starting the tightening cycle for quite some time and telegraphing exactly what they're going to do. It starts with communication, and then it starts with tapering down of quantitative easing. And now today, they're actually raising the short-term rate. And all of that has raised the borrowing costs over time. So what happened during this beginning of the year prior to the invasion? Well, we had a sell-off of unprofitable, high-growth pandemic names. So I think the ARK fund is the poster child for this. It's down well over 50% from its highs. I think it's nearing 70% now. Inflation was a controllable problem then because it was a supply chain issue, and the Fed, which can control the demand in the economy pretty effectively by managing monetary policy, could help. And that was the plan by dumbing down the outsized demand that we were having in the economy. We had overwhelming GDP surprises in Q4. We were expecting a very strong GDP in Q1 as well. And the Fed their plan was to raise rates and dumb down some of that overwhelming demand. And the question really was just how many times they were going to raise. Were they going to raise 50 basis points or 0.5%? in March, or the normal routine 25 points or 0.25%. It was my expectation that under this scenario that inflation would have peaked in 2022 as some tightening slowed the excess demand, similar to a 1946 to 1948 scenario where post-World War II, soldiers came home, they had money in their pockets, and they spent overwhelmingly on goods and household formation, and then that tapered off into when you got to about 1948. Now, all that changed with the invasion of Russia. I want to tee it off with this slide before we start to talk about the greater implications of the invasion. Russia is experiencing a depression and a financial crisis that's very significant and can't be understated. The sanctions are overwhelming, and the Western world has really rallied around punishing their economy and the oligarchs. And that remains to be seen if there has any lasting effect on their decisions. This chart shows the Russian exports and the imports. I want to concentrate on the exports on the above line. The red portion is the EU. You can see that they have a disproportionate amount of exports and imports from Russia. So they'll be overwhelmingly affected by the sanctions disproportionately from the US. So we need to keep that in mind as we think about policy going forward, that the EU is going to take the brunt of these actions. Now, the war has changed the disinflationary dynamic that we've had for the last 40 years. So following the 1970s and Paul Volcker, and it started off a cycle of disinflationary trends, most notably because of globalization. Now the world is definitely more siloed in the spheres of influences following the invasion. So what does that change? Well, wheat, energy, and industrial metal supplies are definitely constrained. And you can see that these are the value of the Russian exports by category. You can see the red part there is oil, natural gas, and other mineral products. But food and agricultural and metals and precious stones are also big exporters. So we're going to see inflation pressures cannot be as controlled as easily by the Federal Reserve, because the Federal Reserve can only really affect demand. They can't necessarily affect the supply that's available. And now there's a lot of supply that's no longer on the market. This is akin to the oil embargo following the Yom Kippur War in 1973, where the Saudis essentially said that OPEC is no longer cooperating with the United States due to the actions in the war, and we lost a huge supply of oil. The Fed's likely to stay more dovish and accept higher inflation to avoid a deep recession. This is a big change from what we saw prior to the invasion, where the debate was only about how much we were going to tighten. Jerome Powell basically came out and made it very clear already that it's going to be a 25 basis point hike, or 0.25%, rather than a 0.5% hike. And we've likely seen long-term inflation expectations accelerate because of this new dynamic, this change that we've had from the 40-year dynamic that we've had since the early 1980s. And we've seen that the longer-term inflation expectations have risen, which will likely in time raise longer-term interest rates. So, definitely a different dynamic than we were in just 3-4 weeks ago. So what has the market done post the invasion? It hasn't done well. Particularly the NASDAQ names are more impacted by the S&P 500 names, as the growth stocks have reacted to the expectation of further increases in interest rates. Now, it's important to continue to take the long-term view. I stress regularly, and I recently wrote an article for retirementinvestor.io about stocks being for the long term. And this is a great example of why. Unfortunately, poor geopolitical relations with the Russians or the Soviet Union aren't new. This graph shows the S&P 500 return from the Pearl Harbor through the end of Vietnam, or at least the US troop withdrawal from Vietnam in March of 1973. And we had a 4,611% return over that time frame. Now you can see that there's peaks and valleys. There's no doubt about it. But overwhelmingly, if you were able to stay in it for the long term over decades of reinvestment, you would have done very, very, very well. And I get into this a little bit more in the article, so I encourage people to read it. I'm sure it'll be up on our website too soon if you prefer to get it there. So I often say as well that corrections are normal. We mentioned that we're in a correction. And I think that sometimes people think I'm being hyperbolic about it, and that makes them feel like they can take more risk. This is a great chart from JP Morgan. This shows the lows in red that we've had in any given year. And then the gray bars are the return for the actual calendar year. In that same article that I mentioned, I have a great chart that shows that we've had corrections. We've had 4 corrections in the last 5 years. So sometimes it can happen even more than once. But I wrote down some of the years here so you don't have to go and look through every single red dot there. For the last 15 years, we've had at least one correction, at least one. So for example, it happened twice in 2018, but we had at least one in 2022, 2020, 2018, 2016, 2015, 2012, 2011, 2010, 2009, 2008, and 2007. So again, this is not abnormal. Things happen. Today it's a war. A couple of years ago, it was a pandemic. We had a European debt crisis in 2013, 2014, and 2018. We had another rising rate cycle. And then obviously the great financial crisis led to many corrections between 2008, 2007 and 2010. Now, here's the good news. Markets tend to do very, very well following a correction. The median over 1 year is 30.5%. The average is 32.4%. And over 2 years is 45.7% and 43%. So, again, I know it's difficult, but this is largely a psychological game. It's largely, understanding who you are as a person, your ability and willingness to take risk. A lot of us have the ability, maybe we have excess means, but we're very uncomfortable looking at our portfolio go down every day. Some of us are, have more of a gambling impulse and have the willingness, but don't necessarily have the means. This is why, having a financial advisor, in my opinion, is extremely important. You find out what's the right level for you so you can withstand the low points and ride it out so you can get the benefit of the high points. Now, let's talk about specifically what's happening. The stocks are pricing in the new risks. So it's not that we're not acknowledging that there's new risks that have entered into the market, but I weigh that against how it's being priced in the market. So you can see that we had a price to earnings ratio north of 22 for a while, and today it's closer to 18.6. It might even be a little bit lower. So stocks have gotten cheaper, at least on this measure. Now, here's the real interesting thing. Even though that stocks have gotten cheaper, we've had a sell-off, 12%, 13% on the S&P 500, north of 20% on the NASDAQ. The forward estimates for earnings have not come down. So it doesn't mean that it won't come down in the longer term. I usually put in an expectation for revisions in my fair value estimates, usually 10% for any 12-month period. Right now, it's probably more 6 to 8% based on the performance of the first quarter for 2022. And you can see that the consensus actually has gone up since the invasion. So on March 24th, we had a forward earnings estimate for the S&P 500 of $229, I'll round up. And as of March 3rd, it was $230. And I can confirm that it hasn't changed much in the most recent reading that we've had. So that's all setting up for a good valuation picture, even if it's a little bit nerve-wracking. So I do want to concentrate on some possible catalysts. It is possible that we could have a ceasefire, and we have seen with negotiations, and the stock market has reacted very, very positively on days where there's negotiation. This really hasn't been good for either party. I mean, we all know what's going on with the Ukrainians, the huge amount of refugees that are fleeing the country, people's homes are being destroyed, et cetera, et cetera, et cetera. But Russia, it can't be stressed, is fundamentally weaker. I think they thought they were going to roll in there within a week and be able to set some new rules, and that's obviously hasn't been the case. I can't stress enough that their economy is an absolute shambles. So there's probably room for negotiation. And what has Russia told us that they want? They want a neutral Ukraine. Well, Ukraine was essentially neutral to begin with. They hadn't joined NATO. They probably are more interested in joining NATO now in a lot of ways. But politically, this has been very unpopular in the Ukraine to be neutral. And hopefully, maybe now that the political outlook has changed a little bit, it does seem like President Zelensky has changed a little bit there, and he's willing to negotiate on that point. The second point that they wanted was a demilitarization of Ukraine. I think this is a place where Putin could claim victory if he calls his, quote unquote, special operation a success, and that he's demilitarized Ukraine. He might be able to sell that and save some face to the Russian people, and that could be, a negotiation point. Now, I think the biggest problem is probably going to be some kind of agreement on Crimea in the Donbass region, which Ukraine obviously does not want to give up. But between the neutral Ukraine and some kind of agreement on the Crimea and Donbass region, that's in a lot of ways looking at the status quo. Crimea was annexed in 2014, for example, and the Donbass region has a lot of Russians in it, quite frankly, and they've been rebelling in one way, shape, or form for years now. Now, whether that's been Russian influenced or not is certainly up for debate, or maybe not for debate. But there is some argument to be made that a neutral Ukraine and an agreement on Crimea and Donbass would be the status quo, and then Putin could save some face with demilitarization, which would could cause room for a ceasefire outcome. Now, we've obviously been experiencing spikes in gas and oil immediately following the invasion. It was quite obvious. We had oil run to $120 a barrel. It's since actually fallen 30% in the last week. I can get into that if we want to get into to China and the problems that they're having at all. But a lot of these concerns are going to be taken off the table if we can get greater supply of oil and gas and energy in general. So one of the things that could happen is U.S. shale could ramp up. We could have Iran rejoin the nuclear agreement and get more output that way. We could have greater output from OPEC to take advantage of the higher prices. Now, the worst kept secret in economics is that the OPEC nations cheat on their production agreement. So I think you could pretty much bet that at $100+ a barrel, they're going to be cheating and putting more supply in the market, which may have contributed to the steep decline in oil that we've seen in the last couple weeks. And finally, China joining the global community condemning the attacks would obviously be very bullish. Now, I think a big question that a lot of people have is whether or not the U.S. will go into recession. I think the consensus right now is the U.S. likely avoids a recession. That might not be the consensus for Europe, but it is the consensus for the U.S. And why is that? Well, we do have energy independence. What may feel like pain on the coast, for example, might be fantastic for the middle south of the country. Primarily the West Texas region. So it might be a wash in the end. Exports are only 11% of the economy. This is a big difference, a big advantage that the United States has, against China or Russia, for example, where we don't necessarily rely on foreigners buying our goods and services. There's a huge gulf between the open jobs and the unemployed. So the unemployment rate is very, very low. And even with the more recent entrance from the labor force, we still have almost 11.5 million open jobs, which is some of the most ever. And we also have this effect of the pandemics. The pandemic effects are fading. And I think one of the big examples that you saw of this just this week is the airlines, of all companies, are raising revenue expectations. So, there's some good news on that front from the services front. During the pandemic, we were very concentrated on goods, and maybe now we're less concentrated on goods and moving more towards where we traditionally are into services, which is both good for the vast majority of the economy, but also good for inflation. So what have we been doing in portfolios? This is a good, really important question, obviously. We sold any Russia and Ukraine exposure. We had very, very little, but I made sure to get out of it all immediately and quickly before it got any worse. Diversify, diversify, diversify. So we stress to any of you that will listen, and since you're on this webinar or listening to it on YouTube, you probably listen, so that's good. I think you trust that your portfolio is very well diversified. That gives us a lot of levers. So for example, if you're well diversified in your bonds and your stocks and you're not significantly overweight one way or another, we can do things like look for rebalancing opportunities, which is letter D there. If you have excess cash in your portfolio, which we typically keep about 3%, that we only rebalance really quarterly. Sometimes you can look for opportunities with the excess cash that you have. So we actually did that, and we bought a little commodity exposure in many of the portfolios that had excess cash, just a small amount as an insurance, really as an insurance diversifier for your portfolio. And right now, we're getting overwhelmed by new data and new news, but that makes it fun to do new analysis on and prepare for our typical quarterly. I think that our approach that we had coming into the year was a good one, where we encourage people to look at their risk assessment in their portfolios. We had a long stretch of very successful stock market returns, which makes people feel maybe more bullish and makes them feel like they could take more risk. But our approach has been that this is going to be a more difficult year, and so far it has been. But that doesn't mean that we're not really getting excited for some of the opportunities that we're seeing, whether it be commodities, whether it be the cheapening up of municipal bonds, or the overwhelming amount of cheap stocks that we're seeing in some of the mega cap tech names, for example. So those are just a few examples.
So one of the things we want to do before moving on is respond to a few questions. Again, if you'd like to ask a question, use the Q&A button. This is a good time to address some of the questions that have come up. So Brian, the first question that came in was, why don't you move stocks to cash or safe spots when markets tumble or market tumbled, then buy back when there's less downward movement? It's a fair question. I think one that a lot of people entertain. Should we be thinking about moving to things with more safety?
So we mentioned that we entered the year acknowledging that this was going to be a choppier year. And what was one of the things we did? Well, beginning at the end of 2020, we actually were overweight stock, and then we went to neutral weight stock, and with the more recent sell-off, we're underweight stock. So you're actually, on average, taking less risk today than you were certainly at the end of 2021, or even going into the fourth quarter of 2021, than you were all throughout 2021. So it's not that we aren't willing to make some decisions actively. It's that we are very cognizant of the fact that the timing the market is generally impossible. If I could do it, I probably wouldn't have any clients at all, because I'd be on an island somewhere, because I'd be overwhelmingly rich. And most people can't. So the move is to try to find a risk assessment where you can ride out the volatility that we've had. And then when the stock market turns, the stock market turns. Now, my approach to buying stocks is really based on value. But here's the downside of buying value. Sometimes the stock market can stay irrational for an extended period of time. A year, even 2 years is not abnormal. But in 3+ years, it usually starts to make a whole lot of sense. So since you can't time the market, one of the best things you can do is find good value and make sure that your asset allocation is in line with your risk preference. So if I were to go in all cash, or even take significant amounts of cash down, then I'd probably miss the eventual upswing.
Yeah, I think it's a natural tendency to want to try to sidestep volatility. I think one of the challenges is that things can move unexpectedly. and it becomes difficult to do, not only to get out at the right time, to get in at the right time. And so we really feel strongly that, although we do make some adjustments on the edges, the best way to try to manage risk is to have the right asset allocation, the best mix that can fit your temperament for how much exposure. And then on the edges, we try to make adjustments, do some rebalancing, just buying low and selling high in the process. Some tax planning in the process with taxable accounts with capital loss tax harvesting, things of that sort. We do have another question, and hopefully that answers the questioner's impulse there. Feel free to talk to us directly if you'd like to talk about it more, or if there's something you think maybe you're uncomfortable with your own portfolio. Another question came in from David. He says, if the U.S. has to increase oil, shale, natural gas production, how will this affect the transition to renewable energy sources, wind farms, solar panels, and increased energy usage in vehicles and buildings? I think it's a fair question. I mean, I think there may be an issue of supply and demand that's part of that question. And there does seem to be an irreversible trend that we are moving toward a more efficient, energy consumption, in our country over time. But there remains a demand for consumption of fossil fuel resources. And with the disruption in Russia, there's a need that needs to be filled, and that doesn't make it irreversible. Brian, you probably have better insights to share.
This is a short-term versus long-term kind of question, right? So in the short term, it's only going to be worse for the environment. In the longer term, I think this is we're going to continue the trend that we've already been seeing. So there's going to be an overwhelming amount of government spending, both in the Eurozone and China and the United States, on moving to clean energy, both from a national security standpoint and for an environment standpoint. China, for example, I have in my notes here, one of their long-term issues is that they import almost all their energy, and it primarily comes on ships. So that's a clear national security concern for them. The Eurozone has made huge investments in clean energy in the most recent years, and it's actually hurting them in the short term because they don't have the natural gas and oil reserves necessary during this trying time with Russia. The United States is the same thing. I think from an electric vehicle standpoint, what this crisis has done is really caused some huge inflation in some of the inputs that go into electric vehicles, which could be a near-term problem for that industry, which obviously has gotten very bullish. People have been very bullish on for a few years. We've seen a lot of new companies come in. We've seen Tesla go dramatically higher. But in the short term, I think you're going to see more oil drilling because it's necessary from a national security concern, from an inflation concern, so that's the situation we're in there. So oftentimes I get asked, well, how come we're not overwhelmingly in oil and gas? Well, part of the reason for that is it's a cyclical industry, and over the long term, the outlook isn't as good, quite frankly, as some other industries. So you want to value a cyclical industry differently than you want to evaluate a secular grower.
All right, thank you, Brian. Again, if you have more questions, we'll have an opportunity to address them throughout the presentation. Feel free to use the Q&A button. Next, let's talk about some financial planning considerations. This is just reinforcing some of the points that Brian made, and that is that, throughout history, there's been numerous occasions where markets get disrupted by geopolitical events. And these are typically things that within a relatively short period of time, 1, 3, 5 years, these kinds of concerns do tend to be resolved in the market and provide us with favorable performance again. So, you know, I think the key point here is just sometimes these things are slow to have to resolve, but they do resolve with time. When it comes to inflation and thinking about your own personal situation, I want to encourage people to keep in mind that sort of Goldilocks situation when it comes to liquidity reserves. Not too much, not too little, just right. You know, we need enough for that confidence, that sleep factor, enough that people feel they have a resource that can allow them to bide their time with the portfolio because they have some resources on hand. Given a little bit of time, we do expect portfolios to rebound nicely. So we want to have some resources on hand. We typically encourage people to have in retirement 1 to 3 years of living expenses, less those fixed resources like Social Security or pension. So just for simple illustration, if you spend $100,000 a year, but you have $50,000 coming in from Social Security and pension, you might want $50,000 to $150,000, 3 times that net difference on hand, okay, as a liquidity resource. Now, people often are frustrated by the fact that it's not making much being in cash. That's true, it doesn't make much, but its virtue is its stability and liquidity in the event that there's a need for avoiding taking from your portfolio at times, or for unexpected expenses that can range from, you know, purchases that may come up or big healthcare costs. For people pre-retirement, we generally keep a smaller amount, something closer to 3 to 6 months of expenses, but assume you may, you know, have a period of unemployment or disability or something. How much would you want to have as a resource then? You know, we mentioned this in our last quarterly economic presentation, and that is that stocks and bonds both have historically outperformed inflation. It's not to say that there can't be periods where they underperform, but given time, where inflation is a concern to people today, no question, it is something to keep in mind that both stocks and bonds over time typically do stand up well relative to inflation. We mentioned commodities as well, a lot of attention toward commodities these days. There can be some virtue to using commodities as part of your portfolio. We've talked about using them tactically in our strategies. So we may use them, as Brian mentioned, as a modest hedge right now. But and there have been other times when we've owned gold, as an example, more recently. But these are driven by our expectations for future tactical price movements. I would encourage people to think not in terms of quarters, but in terms of years when it comes to your portfolio. We are also focused on the here and now and what's happening in our midst in the immediacy. With investing, it's oftentimes better to try to think longer in that vision. What's out of place and maybe opportunistic can get us better results sometimes, thinking opportunistically and thinking defensively. So, you know, additionally, when it comes to the issue of inflation, we've had the benefit of it being extraordinarily low over the last couple of decades. The fact that it's higher today works into an average number over time. You know, I don't think we expect to see 7% on a prolonged basis for inflation. So although it may be spiked here, it may be higher for a time, it's not likely to be that kind of an average rate of inflation prolonged. We mentioned I bonds from time to time. These are there's a limit to how much people can obtain, $10,000 per individual. We can't buy them for you, unfortunately, in your portfolio. These are things you get directly, or kind of like you would think of a savings bond in a sense. TIPS have been something that people tend to think about in the midst of inflation, treasuries that are inflation protected securities. Brian, we've talked about this, I think, on the radio show before and from time to time, but these have some hidden concerns in a rising interest rate environment when duration can be a concern. Maybe you can explain this a little bit.
Yeah, so they're called treasury inflation protected securities. So when there's a high inflationary environment, naturally people think, why aren't you buying these assets in my portfolio? They're supposed to hedge against inflation. Well, that's nice, thing that they do to name it that, but it's not necessarily the way that it works in practice. So the best time to buy these is actually when it's a disinflationary environment. Because then they're very cheap. Right now, they pay a negative interest rate. So you'd actually have to pay the government in order to have these assets. Now, why do they call them treasury inflation protected securities? Because what they do is they add a percentage to your principal, but you don't necessarily get your principal during the inflation years. You get them in out years. And when there's a lot of inflation, it's more likely that we're going to have higher interest rates, which makes your duration longer, which makes the fact that it gets tacked onto the principal rather than the coupon payment more risky from interest rates rising perspective. So if you're wondering why we shy away from TIPS, that's the reason. If we have a prolonged disinflationary environment again, which I hope we have, then that might be something I'd be interested in for the longer term. But right now, I would be more interested in short duration bonds rather than increasing duration bonds, or floating rate bonds, which is where we have had the emphasis in your portfolios.
Excellent, thank you. So again, when we're thinking about things like inflation, what are some things we can do from a financial planning point of view outside of the portfolio to help deal with these issues? One of the answers here might be number 5, to think in terms of when you turn on your Social Security benefits, if you have some assumption of longevity, if you have not yet done this, people who may live beyond age 80 may benefit by delaying on turning on their Social Security benefits and maximizing that benefit so that they receive a higher Social Security benefit, and the CPI that they receive each year would be on a bigger amount. Essentially, each year you delay from full retirement age to age 70, you do get an 8% increase in your Social Security benefits. So that's a pretty material number, and it doesn't take long to catch up with what you delayed on not receiving, as long as you expect to live to 80, 82 kind of a range or longer. For one of two of you, whoever is the larger amounts from Social Security, this is when we think about doing things this way, because one of the two of you might benefit from that if there's a married couple. Another thing to consider is trying to mitigate high inflation healthcare costs. Examine your healthcare coverage, the solution you have for that. Maybe consider whether or not an insurance solution for managing long-term care expenses is worthy of your consideration. One of the other things that's come up routinely is the question of, why do we like bonds? And we took a couple of minutes in our quarterly webinar in January to talk about this, and I thought this was worthy of some repeating, because naturally when interest rates are expected to rise, people have this as a concern. Should we be in bonds? And Brian, I'll invite you to share some thoughts on this, but so feel free to chime in and join me in this segment here. But basically, the first thing is that bonds don't, when they do have bad years, they tend not to be down drastically. Even in a bad year, we tend to say that a bad year in bonds is like a bad day in stocks. the degree of movement that they can be negative tends to be much more modest than it is for stocks. And that's its virtue. Bonds are not stock and they have a lot less volatility. And ultimately, with some time, we get the dividends, the income, and that oftentimes offsets the disruption in price. And ultimately, because of rising interest rate environment, can give us more return that we can overcome those displacement in price. It's important to see here, as on the second bullet, in the last 100 years, there may have been 2 instances where triple B bonds, which are in investment grade bonds, had negative returns in back-to-back years. So even though there may be disruptions in a given year, they tend not to be prolonged. And so, when it comes to the aggregate bond index, a 32% return over 10 years, that's compounded to total return. That is far more than what we've seen in inflation. And so will that continue? That remains to be determined, but we think it's likely that bonds continue to be a useful tool in trying to manage risk and outperform inflation. Brian, anything you want to add to this page before I move on?
Sure. So I think I'm just building on some of the things you already said, Chris. I think you did a great job. There's 3 primary reasons why we have bonds in my mind. One's to diversify away from equity. The second is to preserve your capital. And finally, the third one is to generate some income. So very few clients of ours have 100% stock portfolios, and even less have anything that reflects what is going on in the NASDAQ, which is in a bear market. Now, if you ask yourself, are you comfortable with having regular 20% returns, then I encourage you to be 100% in stock. Just to put some numbers to that, if you have $1 million portfolio, that means that you need to regularly be okay with your portfolio going to $800,000. That's a $200,000 loss. As we add bonds to the portfolio, that math changes very, very dramatically. For example, on a 30-70 portfolio, I would expect a normal loss to be more like 6 to 8%. And for a 50-50 portfolio, somewhere between like 9 and 11%, for example. So, you're talking $50, $60, $70,000 on a 30-70 versus $200,000, and $100,000 versus $200,000 for a 50-50. Now, over time, even if interest rates are low, you will get paid on bonds, and it's not nothing. Like Chris mentioned, that it has kept ahead of inflation for a pretty good amount of time. And as interest rates go up, it might be painful in the short term, but unfortunately, principal adjusts immediately, and income takes a year to come into your portfolio. So it might hurt you a little bit in the short term looking at your portfolio, but then over time it'll pay you interest income, and then typically it has a bigger distribution at the end of the year. So sometimes you need to exercise a little bit more patience to have the income come in. Finally, when it comes to diversification from equity, you can also diversify within your bonds, where you can have things called negative convexity. I won't get into all that, but basically I can get into short-term bonds, I can get into floating rate bonds, and they can provide income in a rising rate environment. And finally, when yields go up, your bonds fall less than if the opposite is if your yields fall, your bond will rise more. So you have that nice little dynamic, and that's called convexity. So you have an asymmetric risk there. As yields go up, you won't lose as much as you'll gain when yields go down.
One last comment, Brian, and that is, as you pointed out, that things don't always go as expected too. Everyone's expecting yields to move in a given direction, and that to be pricing pressure on bonds, but things can change the dynamics where that can change rapidly. I would appreciate if you would share your thoughts as it relates to this next slide, which talks about some of the historical context of a rising interest rate environment.
Yeah, I love this slide, and especially based on that last bullet point that they had on the previous slide that says, everybody knows bond yields are going up, why being bonds? Well, the red line shows the 10-year Treasury yield from post-World War II all the way up through, the beginning of the 1980s, very similar to that stock market chart that I showed from the, Pearl Harbor through, the end of Vietnam. This one extends a little bit further. But you can see here that even with a rising rate environment, you have some overwhelmingly positive years in the bond market with a few very minor down years sprinkled in. With we mentioned the point that a bad year in the bond market is a bad day in the stock market. While the lowest return during this period that we saw on a 10-year Treasury is 3.2%, and that happened in 1969. Now, you ask yourself, how's this possible? Well, it's possible for the exact reason I was mentioning, where yields don't go down as yields go up. The principal doesn't go down as much as it goes up when yields fall. So what happens is, as yields go up, you get paid more interest income, which is a great thing, right? So you might have some short-term pain to your principal, but over the longer term, as those interest payments come in, your total return is better.
Thank you. So a couple of things to consider here. Don't overreact to any one event. Take the long-term perspective when it comes to your investing. Keep diversified portfolio. It's important to have, we've talked about that earlier. Although rates are expected to rise, remember, things don't necessarily go always as expected, as we just said. So there's a variety of things that you should be thinking about, trying to put this into the context of the entirety of your financial plan. And if you're uncomfortable, let's revisit your risk profile and see if we have the right asset allocation in place for you. We did have a question, Brian. I think this is a little more intended for you. Lou asks, is there a possibility of China's currency replacing the dollar? How would that affect us?
It's extremely unlikely. So over 90% of all transactions in the world are involve the dollar. So just keep that in mind. I know that people are have some reservations about the situation in China right now. And to that point, I have some additional notes that I think I'm just going to share with everybody quickly on the prospects of China. China is in a tough situation right now. So I think the long-term goal of the Communist Party in China is to have a prosperous China. The Communist Party has survived just fine without Taiwan for many years now, north of 70 years. And China is having some significant short-term problems, and because of these short-term problems is part of the reason why we're seeing this giant sell-off in oil over the last week, which is good for us. Hopefully, it'll reflect in the gas prices eventually. They've had a zero COVID policy, so their zero COVID policy has led to widespread shutdowns throughout the country that they're actually having right now. The second biggest port in China is actually shut down right now, and it will be for a week. Due to a COVID outbreak, and a city of 18 million people was also shut down. They don't have a lot of natural immunity. They don't have the Pfizer and Moderna vaccines that we have. So I think they'll be experiencing the COVID issues for a lot longer than certainly the United States will. They have a huge property and construction issue where they need to restructure a lot of debt. And this is the biggest part of their economy. So this is a significant short-term issue. You might remember the Evergrande issue. It's probably off the front pages, but it's certainly not off the minds of the Communist Party. And then additionally, they have a significant trading partner that's now in a financial and economic crisis in Russia of mega proportions. They have longer-term problems too. That this isn't unknown to the Communist Party. They're energy dependent. So I mentioned that briefly in my earlier remarks, where they have to import all of their energy. And if you're thinking that they're going to get it from Russia, that's not going to happen, because even though they share a border, there's just a whole lot there's about 3,500 miles of nothingness between the Chinese border and any Russian city of note. So that's not going to be an easy thing. But most of their energy comes via boat. And one of the reasons why they've been stressing green energy and electric vehicles as well. They have huge productivity issues that's really leaving the middle class stagnant. The restructuring of the property and construction industry is not helping this. This is a common problem in emerging market type economies, where they try to move from a goods economy to a service economy. So that's a big risk to the government. they have a demographic problem. They're aging hugely. You might remember that they had the one-child policy, which created this kind of gulf of labor. And older people spend more, and younger people tend to save more, which will make them more reliant on foreign capital over the long term. I mean, there's a real risk that their current account goes negative, and that basically means that they need foreign capital to sustain what's going on. It also means that they're going to have to continue the export economy. They're going to have to rely on the United States to click that Amazon delivery button over and over again for a long time. So I don't think that we're at any risk of the Chinese taking over the dollar anytime soon. If you think about the reasons on why we're the reserve currency, it's really because of the effects after World War II, and a lot of those dynamics really haven't changed in the last 80 years to any significant degree.
I know there was some news on this morning that was being discussed, and so I'm sure that's part of the curiosity here. We get this question from time to time, but I do think at this point, we do not think this is a high probability event. So hopefully that's helpful to you, Lou. Did have a few other questions here. One was asking about I-bonds as a place to park reserve cash. Yeah, I think I-bonds can be a useful place to think about some of that liquidity money that we mentioned earlier. That's a reasonable choice for in addition to bank type location.
Chris, there's one hang up on that. It needs to be held for 1 year.
It does need to be held for 1 year. So if you're doing 1 to 3 years of expenses, it could be a part of that. But right. If you're doing less, perhaps not. Thanks for pointing that out. Good point, Brian. Susan asks, I think a question that a lot of people might wonder. And by the way, I just want to mention we're running a little bit long, and so we will go until we conclude our materials. Hopefully, you'll be able to stay with us for another 20 minutes or so. Susan asks, considering the potential for upheaval in Europe and the European economy, should a portfolio continue to hold international exposure? And she specifically asked about international bonds.
Well, we don't really hold any international bonds of any significance, so
our strategies
about that. Yeah. We are significantly underweight international stock, but we do own some, and there's some good reasons to. We've talked about it in the past, and I understand that they've underperformed over time. But particularly, we own in the 85-15 strategy, for example, we own an India ETF. They are experiencing a transition of people into a middle class. They're becoming less socialist. There's a lot of reasons to like the long-term trajectory of a country like that that has well over 1 billion people. We spoke a little bit about energy, for example, and despite the huge energy problems that Europe has had, and their energy prices were, even before this issue, were far higher than the United States. Germany has still shown a unbelievable ability to be a great manufacturing economy, and their productivity has just exploded. So when it comes to industrial use, I'd say Europe is a great way to diversify your portfolio from the bits and bytes economy that we really have in the United States. Now, that's not to say that the bits and bytes economy hasn't been great and a huge performer, but I do think it continues to be a good diversifier. But again, we're underweight. We acknowledge that there's issues, but when there's issues, it also represents the most opportunity as well. So that's something to keep in mind. Okay, thank you. So let's continue on talking about putting some context to, when there's nervousness in the market. Your financial planning projections are certainly part of that consideration. Let me turn things over to Scott Birmingham to share some insights. Scott?
Thanks, Chris. There we go. If you've done a plan with us in the past, these screens should probably look familiar to you. Speaking in context of what's going on now, you should have a certain amount of comfort knowing that the plans, projections we've done for you have modeled into the corrections that are going on right now. So as Brian said earlier, corrections are normal, they happen regularly, and those are modeled into the Monte Carlo scenarios, which I'll talk about a little more later on. They're modeled into these plans. So again, looking at the top left-hand corner here, 95% probability of success. So that factors in multiple scenarios based on your portfolio, with the market going up, the market going down, and corrections are a normal part of that. In fact, the program actually takes into account things that are called fat tails, so much more extreme than a correction. So you should have a certain level of comfort knowing that these are projected in. If you haven't looked at the plan with us in a while, feel free to contact me directly. We can redo the plan, we can review things. If you've never done a plan with us, that's something we should definitely look into. If I will point out, if you hadn't done a plan with us in, say, a few years, over the past 2 years, we've been slowly transitioning our clients from one platform, Money Guide Pro, over Right Capital, so things might look a little different. But we thought the planning software offered a lot of features and benefits that were a lot more attractive to our clients, so we've been slowly moving that over. So again, if you haven't sat down with us a while, that's just an initiation for us to start moving that plan over to Right Capital. One of the features I like about it, it has great client access. So besides us sitting down and reviewing things, you can just dial into the program and take a look on a regular basis. Now, again, I don't want you looking at your financial plan on a weekly basis, but if you want to take a look at it, after the market's had a correction, that's completely understandable. I will also point out, if you have done a plan with us in, say, the past year, the team around December decided to look into the modeling behind the plans and looking at the kind of the built-in features, the built-in numbers, essentially, for future projections for asset classes. We decided to tamper those down just a bit. We thought they were a little too rosy, and we wanted to be a little more conservative. They were probably based on the fact that a little more historical numbers, that things have been great for so long. We wanted to make our plans a little more conservative, probably a little more realistic, using future projections and looking at those numbers.
Seems there's a little delay from the time I hit it to the time you're seeing it. Sorry, that's the case.
No. So how much is needed? So if you have not done a plan with us, here are the basic rules of thumb. At age 55, you would like to have accumulated for retirement 7 times your salary. So simplicity's sake, you make $100,000, you should have accumulated 700,000. At age 65, it would be closer to $1 million, $1.1 million. And then I think everybody's heard of the 4% withdrawal rule. Again, if you had $1 million, you could expect to take out 4% or 40,000 reasonably over your lifetime without running out of money. Those are fine. They're just rules of thumb. That's exactly what they are. But when we sit down with clients, there's other factors. How long we live. I think the majority of our clients are telling us they're having 1 parent or 2 parents living into the late 90s. How much do you spend? Do you think you'll increase your expenses in retirement for a number of years? Go on vacations, give gifts to the kids. Those have to be factored in. How is your health? Healthcare costs increase much higher, at a higher rate than typical inflation numbers. And perhaps you go into retirement already with high healthcare costs. And then these rules of thumbs don't take into account your portfolio. They're just rules of thumbs based on an average number. They don't take into account your portfolio. Is it 50% Roth? Is it taxable? Is it all non-qualified, meaning it's in an IRA or 401k? So I'm using kind of a subtle hammer to let you know that you probably should do a financial plan. That rules of thumb are great for just giving a quick look, but they're not really what you need. So when we sit down with clients, we want to take into account unforeseen challenges. So essentially, we want to stress test your financial plan. What would happen if you had a long-term care event? Can your portfolio withstand that for one of you or perhaps both of you? Loss of a spouse. How does that affect the other spouse for their financial plan? A lot of clients these days have their children moving home for a certain time, or trying to help their children out with the mortgage or debts or expenses. Is that going to affect your plan? Can you do that? Can you get to the kids? Is a big question. And then things like home repair and maintenance. If I'm making projections for clients and they're 65 years old, there's going to be home repairs. There's going to be roofs. There's going to be changing the water heater and things like that. So we want to factor as many things as possible. So this slide just kind of sums that up. So when we're putting the projections together, it's going to factor in your expenses. It's going to factor in your portfolio, specifically how you're allocated. The program takes into account Social Security, healthcare costs, which we inflate at a higher number than lifestyle expenses. The program inflates your expenses and your needs every year. It does a pretty good job at calculating taxes on a regular basis. And then we also want to factor in things like your goals. So I want a vacation every year. I want a vacation every 2 years. I buy a car every 5 years. We're going to have a wedding for the kids in 10 years. So as much information as possible, we want to factor in that plan in order to determine your odds of success. So we're trying to get as real as possible and factor in as many uncertainties and future things. So part of that factoring is using Monte Carlo. So I kind of compare it to using a spreadsheet. If you use a spreadsheet, your expenses just go up every year in a linear fashion. Well, that's okay. But also your portfolio goes up in the same fashion as well. And that's probably unrealistic after the first year. So the Monte Carlo simulations we use, they generate 1,000 scenarios. So the way I explain it is, if you're 65 years old and retiring, and for simplicity's sake, say we project you live to age 95, that's 30 years of living. We're going to run 1,000 30-year lifetime scenarios. Again, it's going to be based on your allocation currently, which we can make a little more conservative over time to make it more realistic, because most folks get a little more conservative as they age. And then the allocation is going to be essentially the return, and the volatility will be randomized. So the whole point of the Monte Carlo scenario is, will your plan provide the income you need given a wide range of returns and possible outcomes in the market? Exactly what's going on right now. So if you haven't updated in a while, or if you haven't done one with us, you can contact me directly. I'm glad to update it. And I'm glad to give you access if you haven't accessed our program before. I think you'll find it very helpful.
Thank you, Scott. Great job. And so I think, my takeaway from that, as you started out, is the idea that, these projections, these planning scenarios we do with people do help to try to give people confidence, even in the midst of challenging times, of the probabilities of a favorable outcome. And if we haven't dealt with it in a while, let's update your plan and see how you're doing. Okay, now we're going to turn our attention to some tax-related things. It is that time of year. It's tax time. Mike Perna is going to give us a couple of ideas of things we need to be thinking about this time of year. Mike, thanks for taking it from here.
Well, thank you, Chris. Yes, it is tax time. And what we find during tax time are what I call surprises. Many times, clients hadn't anticipated paying taxes to the extent that they wind up paying taxes. And a lot of that has to do with income levels, as well as what we call hidden tax traps. The key term that I'm going to use here is called modified adjusted income. If you look at the bottom of the slide, you'll see the explanation, which is your adjusted gross income, line 11 of the 1040, plus any tax exempt income. And the modified adjusted income is used in two cases for what we call surcharge taxes, one of which is on investment income. If you're a single individual and your modified adjusted income exceeds 200,000, or a joint couple exceeding 250,000, there is an added 3.8% tax on your investment income. So this gets added to your tax, 3.8%. So for example, if you had let's say a joint couple, 300,000, that means that you would have 50,000 over the limit of 250, and you'd pay 3.8% tax on that, which would be about $200 in addition, okay, to the regular tax. So it's an added tax that a lot of people, only become aware of when their tax return is done. Now, Medicare has its own additional tax, okay? And this now is based not on modified adjusted gross income, but on Medicare wages, which is Block 5 of the W-2. In most cases, Block 5 is the total wages that you made. Block 1, which shows the taxable wages, usually takes out contributions to 401k and 403 plan. So Medicare wages is a more accurate depiction of what you actually earn during the year. So if that exceeds 200,000 single or 250,000 joint, then we're going to be looking at a tax of 0.9% for the amount over these limits. Okay, so we have that situation that we confront, but the one that comes up the most and is often the most punitive, okay, is the one for the higher Medicare tax. This is Medicare Part B. Ordinarily, if your income for a single, your modified adjusted gross income is under 91,000 single, 182,000 for a joint, you pay $170 a month, okay? But go over 91,000 for an individual, go over 182 for a couple, and the amount goes up by $68, okay? And then the further you go up the ladder, okay, if you go up to these categories, 114 and 228, suddenly you're going to be paying double for your Medicare. So this is the one that, seems to crop up the most often, and people are unaware, that it happens until they get the bill. Now, the bill doesn't come in the year or the following year that you go over the limits. So if you went over the limits in 2021, the effect wouldn't be seen until 2023. Okay, and then all of a sudden, you notice this dip in the amount you get for your Social Security, and it's due to the fact that the Medicare went up. Okay, and it went up based on the 2021 income. Okay. Now, there are ways that you can adjust your income if you think you're going to be in one of these scenarios. There's always the issue of harvesting capital losses. And actually with the stock market down now, this would be a time that, you could look to see if any of your assets have gone down in value. You can, if they have, you can sell and take the loss. And oftentimes we recommend replacing the investment you sold with a similar one, at least for 31 days. And after 31 days, you can go back to buying the one that you initially held. 31 days, is called a wash sale. So you can't sell, okay, and rebuy in that 31-day period. You can buy a substitute, but you can't buy the initial investment for 31 days.
For what it's worth, Mike, it may be worth pointing out that for people who are receiving our discretionary portfolio services in a taxable account, they probably have seen a little bit of this kind of action where we've made some substitutions for exactly this reason.
Okay, exactly. And there's also the possibility that if you see, there's a capital gain that you're thinking of taking, well, you may want to, hold off on that. Now, it's important to note, okay, if you think an investment is going to go down and you have a capital gain on it, it wouldn't be worth, generally, it wouldn't be worth delaying the sale. Okay, you want to be careful about that. But if there's a possibility that that investment is going to plateau, then it's something you could think about and try to push it into the following tax year. But I want to emphasize, you'd be much better off taking a gain if you feel that the investment is heading south than trying to work it for the limits that I described on the prior page. And there's also a technique we call qualified charitable distribution, and you can see that explained better in the chart to the right there, the blue chart, which if you take money out of an IRA to meet the required minimum distribution, and then you donate said money to charity, okay, you have to report that as income. Alternatively, you could just have the money be sent directly from the IRA to the charity, and then it never gets on your tax return as income. And that would be another way of keeping the modified adjusted income down. Still, there's also the issue of Roth conversions. We're finding more people doing Roth conversions. In many cases, we are very pro Roth conversion. But once again, the income coming out of a Roth conversion winds up on your tax return. It increases your modified adjusted gross income. So you might want to keep a track of that so that you don't go over the limits that we described in the prior slide. For those who are self-employed, you can also control your income by postponing billing. Usually if we're towards the end of the year, you can send that billing out late so that the payment arrives in the following year, and it becomes reportable in that following year, not in the current year. And for many people who work for small companies and are employees, you can work it out with the management, and you might very well be management yourself, to take the year-end bonus, not in December, but in January, once again, pushing it into the following year. Before we go on, I just want to make a correction. I think that I said that regarding the first slide, the investment income, if your investment income were 50,000, you could expect to pay something like 2,000 extra in taxes. I think
you said 200, but
yeah,
it was 2,000. Yeah.
I'm sorry about that.
No, good catch.
Okay.
And one other thing on this slide that may be worth just a mention, you mentioned that people are thinking about Roth conversions, and of course, whether to do one or not is going to affect your income. But if someone is inclined to do one, taking advantage of market declines can be beneficial as part of the way to think about, the ability to do some, take advantage of that market decline as a way to move money from IRA to Roth IRA.
Yeah, Chris, that's usually one of the most opportune times. And right now, that would be something you'd be interested in looking at. Regarding taxes themselves, people often, who don't go to a professional, and even those who do, there are common errors that occur. And here we're just going to talk a little bit about those things, red flags, things to worry about. One that comes up frequently is that you get a 1099, and that comes from the broker dealer you're working with, and it's inaccurate. Okay, and 2 or 3 weeks later, you get a corrected one. Well, if you sent that 1099 off to the accountant, it could very well be that he puts the information in and it's incorrect, and that will precipitate an amended return. So ordinarily, if you get a 1099, I suggest you wait a week or a couple of weeks before you send it off to the accountant, or before you do your own taxes, to make sure that's going to be the final 1099. There's another problem with many people now are, renting. The rental market has increased. Rental has become, a very popular form of income, the Airbnb. Rental income, if it is a loss, it cannot be taken against W-2 income. It's considered to be a passive loss and can only be taken against passive income. Now, if it can't be used, if you don't have any passive income to offset a loss, it can be stored for future use. So it's not lost, okay? And oftentimes it can be used when the property is sold and a gain is realized. That gain is a passive gain, and any losses that were incurred in prior years can be used to offset that passive gain. This one, number 3 is a big one that comes up often, claiming a home office deduction. With the Tax Act of 2018, the home office deduction was eliminated for employees. Now, ever since the pandemic, many people have been working at home, and it seems reasonable that they had a home office deduction. Well, for those people who are employees, you may have a home office, very legitimate, but it's not deductible, okay? If you are self-employed, that home office is deductible. But the issue is this as well. The office has to be used exclusively as an office. It can't be a den. It can't be your bedroom, okay? It has to be used as an office and solely as an office. And that's an issue that the IRS has red flagged for many years. There's also the concern about taking the wrong education credit. There are essentially 2 credits, the American Opportunity Credit and the Lifetime Learning Credit. And each credit is slightly different. As far as the American Opportunity Credit goes, those pertain to the 4 years of undergraduate study. Lifetime Learning Credit takes place after those 4 years. So that's, the difference between the 2. And you want to make sure you get them correct on the return. And recently, the issue of the child tax credit has come up. And that's because the credit has been increased from $2,000 to $3,000 for children 6 to 17, and from $2,000 to $3,600 for children under 6, okay? And the government has been sending advance credits, advance payments up to 1/2 of the credit, okay, through 2021. And when filing the 2021 tax return, you have to reconcile the credits you received with the credits that you are owed. In some cases, you'll be entitled to more credits, but there may be cases where you'll have to pay money back. So what it comes down to is the reconciliation of the tax credits. There's also the issue now of reporting cryptocurrency transactions. One of the questions that's asked right up front on the 1040 is, have you engaged in any cryptocurrency transactions? Okay, the government is following those transactions closely, and any crypto income you make is reportable income. And finally, there's the issue of the earned income tax credit, usually for lower income earners. And for many people, the credit is determined by the number of qualifying children they have, as well as their income. Now, many taxpayers do not have qualifying children. They may have children, okay, but to be a qualifying child, you have to have that child living with you for more than half the year, and you have to provide more than half the support. So if there's a situation of a divorce, okay, you may or may not have a qualifying child, okay, but the credit is only good for you pertaining to the qualified child you have. Okay.
Right, great stuff. A lot to think about, and some great tips for people as they're thinking about their tax preparation this time of year. Thank you. One additional note that if you do your own taxes through something like TurboTax, you may be able to import data from your 1099s. It does require some information, and if you'd like to get the details of how to accomplish that, don't hesitate to reach out to our office to get set up or to get the instructions for accomplishing that. So that brings us to one more segment here we're going to do, and then we'll wrap up. I've got Jeff Perry to tell us a little bit about our Something More mentoring program that we've initiated, and under his shepherding of creation of this great idea. Jeff.
Well, thanks so much, Chris. It's been a little while coming. It's been a lot of work and a lot of back and forth, and maybe I shepherded it, but the credit goes to the entire team because we've all been really involved in it. Thank you for your willingness and leadership on this to offer a new service to our clients and the probably more likely the family members of our clients. While we're giving advice and helping people with their financial plans, it's not uncommon for a client to say, I have this family member, neighbor, coworker who could really use some financial help. Maybe they have assets, maybe they don't, but they need help getting their life in order. And so this is what Something More Mentoring is all about. It's a program designed to help individuals take those positive steps to reach their financial goals and learn how to handle finances responsibly. And that can be someone who has a lot of money or someone who has no money. We take people where they are in life and give them this opportunity to enter this mentoring program, increase their knowledge about finances, and develop their own personal financial goals and plan along the way. So this list of 7 reasons why someone might want to enter a mentoring program like Something More Mentoring is it's unique to everyone, right? Everyone comes to financial planning, everyone comes to a mentoring or coaching program for a different reason, but here's some common things. Maybe they want help establishing their goals and dreams. Everybody's got thoughts about what they like their future to look like, but to actually sit down with a mentor like myself or another member of the team and go through a process of developing your goals and your dreams, putting them in writing and taking positive steps, it can be daunting for some people. So sometimes that's the reason people want some help. Obviously, some people are just overwhelmed by their obligations and debt problems. Maybe they hear about all these great things that we're talking about. Brian's very excellent with his presentations, but to some people, it's just confusion and they don't know where they should save, how they should save, where they should invest. And maybe they want a financial plan that they can actually understand, not one developed for them, not one that, they get off the internet and kind of plug themselves in, but that they are part of developing it consistent with their goals. And we talk about a lot of things in the process, including the right types and amounts of insurance. We get to the question of, do you need an estate plan? And if you do, what should it look like? What's unique about your personal situation? And along the way, we're there to talk about their personal finances and help them understand their own situation, understand the terms, understand the consequences of decisions, rather than relying on someone who's trying to sell them something. And, I can't overemphasize that. This is not a sales pitch during this mentoring program. It's a one-on-one and an education component with videos on different subjects of financial planning. But at no time during the year, it's a year-long process, are we trying to sell the mentee something specific. So we're just guiding them along step by step. And so they should expect that it will be unique, individual, and not a sales process.
I think it's really a good foundation laying process to give people an understanding of concepts, principles, terminology. It's a real good, and then how it applies to their own personal situation, which can be really important. 12 monthly lessons, 12 monthly 1-hour sessions one-on-one.
That's right. And so they start any given month with a video lesson, which I lead, but it has other members of the team. You just heard from Mike Perna. He chimes in from time to time with some of his thoughts on his experiences over his 30 years. You've been a guest on the mentoring and other members of the team. And so they get that basic understanding of the given topic of the month. Say, for example, we're talking about debt and credit scores. We give them a video lesson, which covers the basics of it. And then the mentee schedules a personal one-on-one mentoring session where we take what they learn and apply it to their individual circumstances. So for example, debt, we'll talk about their debt and whether or not we should help them to develop a debt reduction plan. Maybe they are looking at buying a first house and we talk about how that works. How much debt should they take? How much can they afford? And how it might impact other long-term financial goals. So we take the general video lesson, which is applicable for everyone, and then we apply it during the personal one-on-one mentoring session to their unique circumstances. And hopefully they gain the knowledge, as the list says here, of the basics of personal finance along the way. So if you know somebody who might be interested, whether that be a family member, a friend, a neighbor, check it out. We have a link on the website. As you can see here, we're on the website at amrfinancial.com under the services tab. There's a lot of information about something more mentoring, or you can certainly call the office at 866-771-8901 for asking questions, or if you want to enroll. We're really excited to roll this out. We did a press release earlier this week. So this is breaking news here at Asset Management Resources.
Right. All right. Very good, Jeff. Thank you. And we encourage people to mention it to their friends and family as a great resource that they could take advantage of. There's some modest expense associated with it. We've kept the cost very low for the amount of time that we're giving with people. In any case, find out more at amrfinancial.com. We've had questions throughout. I think there are no more questions at this time in the Q&A box. So thank you everyone for your participation. Any concluding remarks? Brian, I'm going to ask you where I think the focus of the questions, the focus of the concern has been on recent market considerations. Any concluding thoughts to give people a little bit of sense of perspective as we, round out the presentation here?
I think the 2 points that I want to get across, as usual, is that, find your asset allocation that works for you and stick with it for the long term. We're not gambling. We're investing for the long term. We want those decades-long compounded returns over time. The market will find a new equilibrium, and at some point, it's going to start increasing to your benefit again. And while that's happening, we're going to be looking for opportunities, and we're going to be trying to position the portfolio in a way that makes sense to us. Sometimes, what I think is really difficult for people is we're not doing what seems to be obvious in the moment. And part of that reason is because it might seem obvious to a lot of people, and the prices might reflect that. And that might mean that there's a lot of risk involved. So we take the long-term view, and we look for opportunities that we can take to help you out in the short term too, but they're not as obvious. And we're being patient and making sure our research is sound.
Very good. We will have an updated economic and market outlook on April 13th. Mark your calendar. Plan to register if you'd like to join us live. We will post it on the website for our clients. Take advantage of our various resources. There are numerous ways we can keep you informed. Remember, each quarter we do 2 webinars. Each quarter we do 2 newsletters, one more market oriented, one more financial planning in nature for both of those. We have articles that we are sending to various places and posting through our website. We are sharing ideas and information through our social media. And again, our radio show is a great resource for talking about what's happening in the moment and how we are, positioning our accounts or thought process surrounding that you can get that by listening to the radio or wherever you get your podcasts. So lots of possibilities. Thank you all for being with us.
Chris,
Yes,
I just want to add one thing. With the
Please.
stock market down, this is a good time to increase 401k and 403b contributions. You'll be buying stocks at a bargain, so.
good point. It's a great time to be taking advantage of these declines in the market. And so be opportunistic as and not just concerned, right? Good point, Mike. All right, well, thank you everyone for being with us, and we will have this posted. If you want to share it, go to amrfinancial.com to learn more. Until next time, we'll say keep striving for something more. Thanks, everybody.